show me where on the chart that if the Fed raises rates, that crashes the market. I would love to know where that is, because it ain't there. My name is Christopher Yule. I've twice been awarded top 100 people in finance. I was mentored by 5 of the market wizards, the best traders of all time. I've been successfully trading since 2009, and this is where we save time, make money, and start with less risk together as a team. Now let's get into the lesson of the day. All right, so be sure to stick around to see how we rank this video out of 10, and subscribe if you haven't done so already. So let's watch this video here. It's by the Financial Education Channel with 106,000 views as of right now. I will put $3 million into this, double exclamation point emojis. And of course, we're starting with our commander-in-chief now. Praise Jesus, he survived this far, Donald J. Trump. And we're going to be watching this at 1.5 speed. So if it's too fast, I might slow it down, but we're going to run this a little bit faster.
Top of this video, before we get into that, obviously transfer of power here today. President Trump is now officially the president once again. So at the top of this video, I want to tell you, am I as optimistic about Trump 2.0 as I was Trump 1.0? Why and why not? So we'll discuss that on the economic side, on the stock market side in this video, if I'm as optimistic or not, okay? Now, the thing that actually went the most viral today actually had nothing to do with Trump at the inauguration. It was actually Zuckerberg got caught taking a little peek at, let's call it Jeff Bezos' fiance, wife, whatever it is now at this point in time. But yeah, he was taking a little peeky boo, so that went viral all over the internet. I'm sure you guys have seen that here today. And you know, listen, let me put you guys on some game here, okay? So some people said, oh, you know, Bezos isn't going to be happy with Zuckerberg. They're going to get in an octagon fight. And I'm like, wait. Let me put you guys on some game here, okay? Listen. Most guys, yes, they think like that. Like, if you check out their woman, they want to fight you. They got problems with that. They creeps them out, right? They don't like that. But some guys are into that. So they purposely have their girlfriends or wives dress extra, that's called S-word, right? So then other guys are looking at them, and some guys get turned on by other guys looking at their woman, right? And then some women love that attention. Not all women, but some women.
I mean, we could skip this part, just saying. Let me skip this part.
Pervs. Okay, so we got Zuckerberg looking down the woman's shirt. Elon wants to get every woman in the world pregnant, and then we got Bezos who's into some stuff. Let's just put it that way. So listen, as long as they execute, that's all I personally care about. If you guys saw my video, 16 years of stock market advice in 52 minutes, what was the most important thing I told you guys? Having a perv as a CEO is extremely important. Okay, that was not one of those things, but that is a legendary video. Check that out sometime if you get a chance. Okay, appreciate you guys for joining me. Action-packed one here today. All I ask from you guys, one thing only: smash that like button. I need you to do it. Hey, it takes you 1 second. Come on, you can do it right now, please. Okay, please, I beg you. Okay, don't make me have Bezos and Zuckerberg come over to your house, okay? Just smash the like button, hit subscribe, and then we can go on from there, okay? Alrighty, guys, so how am I feeling about Trump's presidency in all seriousness here? Am I optimistic, not optimistic? So I did a very lengthy post on X today. We're now well over 40,000 subscribers on X, so definitely running up the follower count pretty quickly here on X. I've started taking that more serious really in the past like 6 to 12 months, okay? So here's what I said. I said, I'm so sorry for what I'm about to say. As I know, a lot of people are super optimistic about today and the transfer of power. And I definitely saw it. Like, a lot of people had that sentiment of like, America's back, baby. We're going to get back on the right track. It's only up from here. Like, a lot of optimism. And that happens every time there's a presidency, right? When Biden got in office, there was a lot of optimism, but it was from a different crowd than certainly the crowd that's very optimistic today, right? Same thing when Obama got in office. Same thing Trump got in office 1.0. There's always a lot of excitement, depending upon which side it's coming from, about a new president coming in. It's a new day. It's a new dawn. Like, here we go. America's back. We're going to get back on the right track, right? And there's definitely that feeling out there. So I hate to kind of be, the guy to be a little more cautious on a day like today, right? But I said I'm not nearly as optimistic about Trump 2.0 as I was on Trump 1.0, economic speaking. Here's a thread on what I'm thinking for the next 4 years. 1, corporate taxes. When Trump took over from Obama, he had massive room to bring down corporate taxes. He was able to bring them down from 35% to 21%. Guys, that's 14 extra percentage points in a company's pocket each year. And it's not like it's a one-time thing, it's every year, right? Year after year after year, versus that money going to the government. It's a huge deal. There was a huge boom to the stock market and corporate earnings. Trump does not have that lever to pull this go round. No. I doubt he's even going to be able to move corporate taxes at all. If he does, maybe he can move it 1% or a couple percent. Like, it's not going to be meaningful at all if he even does move it, which I have doubts if he'll even move it. 2, stock valuations. When Trump took over in 1.0, stock valuations were in a healthy place. Now we're in a stock market that's heavily concentrated. We do not know at the top of the market, right? And P's are stretched versus historical norms. Yeah, there's no doubt. I think this is a
I mean, yeah, that's for sure. The market is very heavily evaluated, right? Or heavily concentrated, I should say. In fact, let's pull up I want to pull up a stock market map here real quick. Let's go to 1 year. So this is not year to date. This is over the course of 1 year, right? You've got Amazon at 50%, Google at 40%, Meta up 66%, Apple up 25%, Microsoft only 10%, Nvidia up 145%, Broadcom 115%. You got Berkshire Hathaway even up 30%, JP Morgan up 55%. So yeah, I would have thought it was more concentrated than this, to tell you the truth. Let's look at 6-month performance. 6-month performance is still pretty widespread, but overall, when the market's up 22 or whatever percent it was over the course of a year, you're gonna have a lot of stocks that are doing really well. But I think that investors, traders, whomever have gotten very complacent that these type of returns are normal. They are not, right? We haven't had any sort of risk event, any sort of correction, really any sort of bear market since 2022, which was bought up like immediately. So, I mean, I'm not saying go all in on puts, and I'm certainly not saying go in on buying all the calls. I would say right now, what's the market doing right now? I mean, it's been going sideways for a while. In fact, we sidestepped a lot of this in Outlier because we got a sell signal on November 21st, which is this line right here. We had a sell signal on that date, which you're probably thinking to yourself, oh, that's not a great sell signal. Look, it went up from that point. It went up 2%. Yeah, but we also avoided all of this chop. 100% of the chop was avoided. I've been sitting on the sidelines since November 21st because of this, right? So it's not all about just pure alpha, right? It's not all about being in the market as much as you can, as hard as you can, as deep as you can. It's about knowing when to be in and knowing when to be out. And when the market's choppy like this, it's a very hard market to make money on. A lot of people are getting chopped up bit by bit, day after day, where you can just sit on the sideline. At least that's what I do. What I look at is called, where's it at? Scrolling a little bit here and there. What I look at is called the master key, right? So the master key starts with the SPY signal, which right now is sitting at a sell, right? It's got a sell signal. And then the market trend, which the market trend is sideways. It might turn bullish today. We'll see. Because you've got the 10 under the 20 period moving average, prices over the 50 period moving average. But that moving average may cross today. We'll have to see. We are headed right into a double overhead resistance, a double order block right here. I know I had some people asking me, where do you find this order block information? I use TrendSpider. I've got a discount code. You can use it. It's called 10-minute. You save at least 35%. But this is something that is completely, I cannot live without in my trading. So the market trend is sideways to bullish. The SPY signal is still on a sell. And then market breadth. This has been really, really great. Let me pull up market breadth real quick. So this shows that number of stocks inside of Outlier with buy signals. And see, it goes from 0 to 100, of course. And we also like to put a moving average on top of this. In fact, this is an indicator that I personally built. So you've got your market breadth has increased a ton recently. It's up to 66%. So 2/3 of the market is bullish right now, which is crazy out of nowhere. Then you've got your moving average right there, right? This is what kept me from going short, right? As the market was coming down, you've got your 10, 20, 50 cross moving down, but the market breadth actually started to trend back up on January 2nd. And that was this point here, right? So rather than going short, I was like, I'm going to hang out. Market breadth is going higher. We're getting more and more buy signals. And so I wasn't short when this face ripping rally started right back up here, going up $21 on the SPY in just the span of a couple of days, right? So you got to merge all three of those together. That's why I call it the master key. It's before I do anything else, I want to make sure the SPY is moving in the direction I want to see. I want to see the trend moving in the direction I want to see. I want to see the breadth moving in the direction I want to see. And once I get to that point, I want to look at the breadth of that sector, right? By doing all this, I've got 80+% win rates, and it just makes it so easy. It's like you're a surfer and you're paddling out and you're waiting for that wave to come, and you get on the wave and it pushes you all the way back in, right? It pushes you like you've never even seen it. It's so much easier to trade or invest or whatever you're going to do with your money like this. So putting that out there. So let's continue on.
This stock market setup anybody's had since probably Bush came in his first term, right? Because Bush took over, was at around 2000-ish. So yeah, I'll say that. Number 3, inflation. This one's very, very important. When Trump took over 1.0, there was no worry about inflation. That was not even like a subject, to be quite frank. Inflation didn't until slightly before Rona happened, right? So by that time, we're talking late 2019. Now we have very serious worry of inflation coming back in the back half of 2025 and into 2026. If that happens, things will get very ugly quickly. 4, Fed funds rate. Listen, guys, when Trump took over 1.0, what was the Fed funds rate at that point in time? It was 0.5%. 0.5%. Now it's 4.5%.
So since you mentioned it, let's go to the CME FedWatch tool. This is a great tool. It's free. Just Google CME FedWatch. You can see where the rate is today. So as of today, current rate's between 4.25 and 4.50. The projected rate, let's say a year from now, December of 2025, the projected rate if we're at 4.25, 450, that's right here, right? The projected rate is anything below that point has an 86% probability of happening. 86%. I saw he's saying rates are likely to rise. In fact, rates are 86% expected to fall. I mean, anywhere from 25 basis points to 125 basis points, somewhere in there. So great tool to use. Definitely one to check out.
5%. We're not talking about a small difference. This is a substantial, massive difference. I mean, it's the same as thinking about, imagine, the Fed funds rate's 8.5%. Like, you'd be like, oh my gosh, that's insane, right? Yeah, that's the sort of difference we have between 0.5 and 4.5. If inflation comes back in 6 to 12 months from now, there will be a risk that the Fed could start raising rates again in 2026, and that would be no bueno. How bad would that get if the Fed has to start raising rates again? I can tell you that would get very, very ugly for the stock market, right? We would have quite some drama play out. If investors started becoming convinced that the Fed would have to start raising rates, how much are we talking the stock market would drop? If that became a serious matter, my opinion is the S&P 500 would drop a minimum of 10%. But that's bare minimum. I mean,
well, hang on. Let's back that train up, right? I hear a lot of people who make those sort of correlations, right? And say, if the Fed starts raising rates, the stock market's going to plummet. Show me where the stock market plummeted while we raised rates. Show me. Show me where the stock market plummeted where we raised rates. We have been basically going up the entirety of the 2010s, the entirety of the 2020s, with the blip that came in 2022. Show me where on the chart that if the Fed raises rates, that crashes the market. I would love to know where that is, because it ain't there. That correlation doesn't exist anymore, right? There may be some little bits here and there, but to say if the Fed raises rates, markets crash, no way, dude. It's not a thing. In fact, let's look at this. Fed funds rate, and let's go to images, and let's go to let's do this one. This will work. So this is what it looked like in, let me make this bigger. Open image in new tab. Oh, look at that. That's beautiful. From Purdue. Right. So this goes back to 2008 to 2015. Rates were basically at zero, right? So let's go 2008 to 2015. Okay. Rates were at zero. Got it. And then rates went up starting in 2015, peaked in 2019. Okay. So clearly the market has to have crashed between 2015 and 2019. All right. That was 2015 here, 2019 here. Yes, absolutely. The market crashed. It crashed upward by 39%. Okay, cool. So when rates are going up, the market will definitely go down. And then we look on the other end, right? 2019 into 2020 and through 2021, the market had to have crashed there as well. Let's see. Yes, the market absolutely crashed right there. It's, I mean, really bad. And then, hang on, where'd it go? And then we started raising rates again. Let's say the end of 2021. Let's even be considerate and say the beginning of 2022. Now, there was a pullback, but after that pullback, it's up 24%. And from the low, while rates are going up, it's up 67%. So people who make that correlation of if rates go up, the market has to crash, that's just not true. It's not true. So I don't want you to be scared about that. If they start raising rates, that the market's going to crash, because historically speaking, in the last 2 decades, that's not been the case. If you want to go further than that, you want to go back 80 years, by all means do so. But in recent history, in the new age that we're living in right now, probably for the people of you who are watching, right, the entirety of your entire life, rates have been going up, except for a window about 4 years where it was at zero. No, 6 years where it was about zero. And it's been going up, in big chunks, in big waves. Yet the market has not crashed. The market has not crashed. The market's gone up while rates were going up. The market's gone up while rates were going down. The market's gone up while rates were sideways, and everything in between. So I wouldn't put too much stock in that.
20 to 30% is probably more realistic if people really start to factor in, hey, the Fed's about to go through another hike cycle. We're not just talking about one hike. We're talking about several hikes over a period of time. 10, 20, 30%, fast it would happen. But
no, I disagree completely. If the Fed went through another rate hiking cycle, there is no justification to say that rates would crash 20, 30%. I think that's fear mongering. I don't think that that's an appropriate way to measure this, right? Because it's just not, it's not the case. That's not true. That correlation no longer exists.
let's see. That's certainly no guarantee, but it's a serious worry, and it's not a worry we had in Trump 1.0. 5, personal income taxes. In Trump 1.0, there was a lot of room for favorable adjustments to be made to personal income taxes. I don't see any major favorable changes coming to income taxes in Trump 2.0. I would gladly welcome it. If Trump has some great new tax plan that, my income taxes are going to go down a bunch in the next few years, I don't see it, though. I don't see it. I think that would be pretty much hopium. I would gladly welcome it. Trust me on that. With what I pay in taxes, but I don't think that's happening. So don't get your hopes up about that. 6, real estate. When Trump took over,
I've definitely wondered how they would make the no income tax work with tariffs. I just don't, I can't mathematically see how they can make that work without making prices of everything be astronomically higher, right? I mean, of course, the objective here is to get more made in America goods, more made in America labor, etc. But if you have a 30%, 50%, 100% tariff on everything coming from China, how does that not make everything we buy 100% more expensive? Which then turns into hellacious inflation. I don't know. In the comments, please tell me, because I don't know.
Mortgage rates were cheap. They were. Like when Trump took over, mortgage rates were in like the 3s, right? And for much of his president, almost.
So I bought my house in 2016. My mortgage rate is 3 5/8, so just over 3.5%. And like, if I were to get the same mortgage today, it'd be like 7-ish%. And my home has doubled in value since 2016. So it would be literally 4 times higher on my monthly mortgage payment if I were to buy the same exact house today. That's what concerns me about the housing market is, let's say you had 1 million people who could have afforded my mortgage when you bought it. Now that it's 4 times higher, you may have an exponentially less amount of people who could afford it. It might be down to 50,000 people. Might be 5% of who could have bought it before can afford a 4 times higher payment now, right? Like I don't know how the housing market's going to recover from this. If I go to sell my house, who's going to buy it? How long do I have to keep it on the market? That's why raising rates is meant to curb inflation, because I can't change what rate they're going to be financing it at, but I can change what I sell my house at. So for example, let's say if I sold the house for $1 million or wanted to sell it for $1 million, I can't find any buyers. So I might have to lower it to 900 and then 800. And then the buyers are at 800 are looking at it like, well, he's already cut it 200,000. Let's give him a little bit of time. And then I cut it by another 100,000. So it's 700,000, right? Because I got to move. I got to get out of here. So my asset decreased by a ton. You as a buyer were so stoked because I had to deflate the value of my house in order for you to be able to buy it, for that buyer pool to expand enough where they could afford it. That's why raising rates helps curb inflation. Now, that in theory trickles out to everything out in the marketplace, but we haven't seen that yet. We haven't seen inflation really turn around and come back down. I mean, the government can say that, but my grocery bill today is 3 times higher. Same number of family people, right? Same number of family members. I don't have any new kids. I don't have anybody else who's moved in, but my grocery bill is 3 times higher than it was 5 years ago. 3 times. So I'm looking forward to grocery prices going down. I'm sure you are too.
His entire presidency, mortgage rates were either between the high 2s to like mid 4s, right? His entire presidency, basically. So mortgage rates were cheap and real estate prices were fair. In Trump 2.0, mortgage rates are the highest they've been in 15 plus years, and home prices are sky high when you compare them to incomes. If prices go up more, that will cause a bigger bubble. If prices go down, then what happens? This is a problem, okay? And this is why real estate screws with Trump 2.0 in a substantial way. If real estate prices go up, right, it's going to cause this whole unaffordability crisis to get way worse, right? Let's imagine, real estate prices go up 10, 20% over the next couple of years. If you think real estate's unaffordable now, wait till it goes up another 10, 15, 20%. Then it's going to be even more unaffordable, right? But here's the other problem. If we were talking about real estate prices going down, that's not going to be good either. And the reason that's not going to be good is because you got to remember who owns like the vast majority of real estate. The same type of people that really spend the vast amount of money into the economy. If those folks see their real estate going down month after month, quarter after quarter, year after year, it's not going to make them feel good. They're not going to want to spend as much money in the economy if you see your home price or your home's price going down and down and down.
And it really depends on their need to sell, right? If I don't need to sell, then I can sit on it for ages, which limits the supply. therefore making the affordability crisis even harder, because that's going to drive up the price of other houses, right? So it really comes down to how fast they need to liquidate the house. If they don't need to, then why would they sit on an asset that's going down in value? Just sit on it, right? Maybe I don't need that second home anymore. I'm good with this one home. So yeah, there's a huge number of catch-22s over in real estate land right now.
Which then would also mean if you have rentals, you're not going to be able to command as high of rents, which also simultaneously makes you not have as much money, not feel as good. In general, your sentiment is going to be lower, right? And those are the people you're really counting on to spending money in the economy. So in regards to real estate market, the important thing that everybody watching this has to understand is Trump is really set up in a no-win situation this go around when it comes to real estate. It's very important everybody understands that point. Okay. 7, commodities. If investors are confident that the economy will be great under Trump, then commodities will pump big in 2025. There's no other way around it. Like if people become very confident in the economy, things are going to be booming, construction's going to be booming, everything's going to be booming, commodities are going to go through a big bull cycle again. It's as simple as that. If people are very, worried, scared about the economy, things aren't going to be good, guess what happens? Commodities go down. So if commodities go on a big bull run in 2025, guess what's going to happen? You're going to see major inflation come back in 2026. Everything that is made in this world ends up coming back to commodities at the end of the day, right? And one of several key reasons we had the crazy high inflation in 2022 was because commodities went through one of the most epic bull cycles you've ever seen in history.
Is that true? Let's look at USO. And let's go back to 2021. Oh, this is month of candles. Okay, hang on. Let's go here. Okay, so this is the COVID crash, right? Where it went down like 80-ish% in oil. But then from April of 2020 up to June of 2022, it went up 350%. All right, I didn't realize it was that big of a move, but it really is. Really, really is.
From basically the second quarter of 2020 to the second quarter of 2022, that commodities bull cycle was.
That's exactly where I put it at, a 352% move in the span of just 2 years. That's a lot.
Unparalleled, unbelievable moves in basically every single commodity out there. So what am I doing with my money? I'll stay heavily invested in stocks that have underlying companies in which they can produce huge profits in any environment. Companies that can grow revenue, margins, net income in any environment. I'll hold $5 to $10 million of real estate. I'll hold another 7 figures plus in cash, that's in savings accounts, CD accounts, things like that. Right. Now, next thing I want to show you that's very important here, right, is here's the thing you gotta understand. Even though I'm not as optimistic about Trump 2.0 as I was Trump 1.0, right, that does not mean we're doomed. That does not mean bad things. We're screwed or anything like that, right? Because here's the thing. Let's say we could even get a 10% gain from the S&P 500 over Trump's 4 years, or a 20% gain. Would that be great? No, that would not be great. But guess what? There's still going to be a lot of money to be made. If you said the S&P 500 goes up 20% over the next 4 years, right? Not a good return. However, there's going to be stocks. If the S&P 500 goes up 20%, there's going to be stocks that perform 60% returns, 80% returns, 150% returns, and 200% returns over the next 4 years, which sounds pretty darn good to me. Even if we got a 30 to 40% return, still would not be good over a 4 year span. However, even if the market returned 30 or 40% over the next 4 years, that would still mean a lot of money is to be made, right? Now, we can say if there's some major crash under Trump's presidency, let's say market crashes in 26 or 27 or something like that, right? There's going to be a lot of money to be made on the downside. If you know how to hedge your portfolio properly, you're going to make more money than you ever dreamt of in that environment as well. So regardless of whatever happens here, whether the market returns 10 to 20%, 30 to 40%, or maybe it's just as good as Trump 1.0, 66% return, or even better, 80% return, whatever. Or there's a crash like there was under Bush, right, in his first couple of years. Regardless, there's going to be a lot of money to be made here. A lot of money be made. And so, that's the thing you gotta understand. Like
I agree with that. But you're gonna have to be smart. You're gonna have to be market aware. You're gonna have to not be emotionally invested in a stock, right? No stock will get you out of a deep hole that you've dug if you forget risk control, right? I'm actually in the process of making shirts. They'll be available down in like our YouTube merch shelf that says only price pays. Because at the end of the day, if you love a company, if you love the story behind it, but the price is going down, like AMD, the advanced money destroyer, if you love the story of AMD, if you love what they're doing, if you love their products, yet the price is just falling day after day after day, it's not going to pay. And you may be sitting on dead money for weeks, months, years before you just get back to break even. Right. And I don't want you to say, oh, I'm trying to get the best deal out there. It is okay to wait, to sit on the sidelines and let the market figure out which direction it's going. You do that with the outlier trend template with the 10, 20, 50. When it's crossed down, 10 under the 20, price under the 50, that's a bearish trend. Right. And if you really are a long-term holder, you should be okay with realizing I'm not going to catch the bottom, but I'm certainly not going to buy it at 150 when it's in a downtrend. Then it goes to 140, then it goes to 130, and then it goes to 120, and then went down to 115. Right? Let it settle, let it figure itself out. Be content with not getting the very bottom, because it's never going to happen. And then once it starts moving back up in price, by all means, go at it. But just remember, the top 10% of a move is the most expensive because everybody's trying to call the top. The bottom 10% of the move is the most expensive because everybody's trying to call the bottom. That 80% of the move between here and there, way easier money to make. Way easier money to make. So let's take a look at this here, and let's ask ourselves how we're going to rank this video here. In the chat, put in what you would rank it as. I'm not going to put it as an 8 impressive, but I'm also not going to give it a 5 or below. This is a solid 6. This is a decent because nobody gets a 7. I feel like he didn't go to town pumping stocks that are going to zero, and gave some decent analysis. He's not correct about where the Fed funds is going, at least that's what the market's saying, and he's not correct as far as what happens with the market if the Fed does raise rate. But you know what? That's subject to interpretation. So I would give it a 6. Let me know what you would rank it as, and of course, tell me what you're trading in the chat. I'd love to hear where you're trading these days. And come back tomorrow. We'll help you save time, make money, and start winning with less risk together as a team here in the OVTLYR Trading Room. Have a fantastic day.